We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. We are back in the studio with Cannon St. Peter. Thanks for joining us again, Cannon. You are the Director of Operations for Peak Asset Management, and we want to pick your brain about deals.
Well, people haven't listened to the other episode.
Why not?
25.
He's 25, owns tons of real estate, brilliant guy, taught us a bunch about AI. We're just geeking out.
Tons of real estate is ambiguous.
30 million is the number that
you gained $5 million worth of real estate since the last episode.
It went
Congratulations.
It went up in value.
You know, Gabe is just recognizing Portland has more value than Salem.
That's what Mike told me. He said Portland's more expensive.
Reevaluated.
We don't really know the number. We know it's it's almost 200 units.
Yeah, and a very small percentage. Like, I'm a humble participant, so I don't think
that's okay.
I'm very happy with the portfolio.
You want to know what I was doing when I was 25? It wasn't what you're doing right now.
Now that you've been on this podcast, I think Bob and Sang need to give you more ownership. I think we just need to say,
I didn't say it.
Step it up. Step it up. Why is
or we're going to steal him.
Or we're going to steal.
Oh, competition.
My portfolio is not big enough to steal him.
Mine is.
My hair only stands up for equity. So.
Better watch out, fellas.
Look out, Bob.
I don't know.
I'm coming for your guy.
You wear nice loose clothes. Sang wears really tight clothes.
Ooh.
Maybe Cannon prefers to be around Sang.
Probably.
Oh, what are you saying?
I don't know.
Since their names came up, they deserve like a huge shout out because both Bob and Sang have given me incredible opportunities, and they are incredible people. Yeah. I mean, they are.
What was your first impression? Did you meet Sang before that meetup when you met with Bob and Sang? Had you met Sang prior to that?
No, I had. I didn't meet. My first impression with Bob is he was just like bouncing off the walls, like energetic, just like a meth head for real estate. And that was a refreshing perspective for somebody that I never knew anybody in real estate. So to start there was fun as a young person. And then, Sang it was kind of like this warm, like kind of a cold start, I should say, that warmed up over time just because I didn't know anyone in the business. I didn't know, like when I met Sang, literally Bob was like, hey, this is said his name. And I was like, Sam? And I shook his hand and they laughed at me. That was the first time I met them. So it started slow. I didn't know what portfolio people had or what kind of skill sets they had. It took a couple years of like realizing who I really looked up to. And then how can I find a fit in their organization or their operation to provide value? I don't think it wasn't obvious when I shook their hand the first time. But you quickly, I think if you're working with the right person and you have enough interactions, like it only takes a couple months before you're like, oh shit, this person really stands out from the crowd.
You've talked a lot about networking and meetups. Do you have some favorite meetups you could shout out in the Oregon market? So
I'm guilty of only going consistently to the Investor Lab meetup, which is now Portland and Salem. Like, this is a bias room, but it's a great meetup. I think all of them are valuable. I used to go to, there was some small East Side meetups. The West Side meetups are great, and I'm mostly out of Portland, but I've never been to a meetup that I like regretted going to. I didn't ever go home late and regret going.
Didn't you just go to one last night? Investor Lab was in Portland last night, wasn't it?
Yes.
Bears versus Bulls.
It was a show.
I heard it was cool. I wasn't able to make it. Was it good?
Yeah, it was probably one of our better debates.
So that's for people listening, that's you speaking as the bull and then a lender or a lender.
Yeah, so Eric Larson, we've done it 3 times in a row. So Eric is very similar to me where he thinks of it like a mechanic, but he's a lender and I'm a developer. So he comes from the lender protectionist side. So like one of his talking points is he's been talking about gold for years. And then all of a sudden gold went up in value. But it's just we see the structure of it. We see how important war is. We see how assets are maneuvered and collected. We see how politicians are puppets. So, for example, I can't remember what his title was, but it was somewhat of a provocative title. And then we're funny. So then the next slide was, well, my interpretation, and it was an AI image of a politician as a puppet with puppet strings and a hand over it. And I said, well, politicians are just puppets and bankers are the puppet masters.
You have a string.
It is, yeah.
He's my puppet. Mike's my puppet. He's got a string hanging off his shirt.
Fred Meyer clothes. That's why I should stick with Costco clothes. They don't fray.
So it was a great meetup. That's what you're saying.
It was awesome. I think there's a lot of value out of it.
What were the main takeaways from his perspective? Because he was always scared of the market the last couple of years, kind of.
Yeah, he's more I think he's excited, like the whole thought process of be human. So when we kind of had a big AI portion on it, and that's what he really got into is be more human. I don't know what I was in it, so it's hard for me to say takeaway.
As far as the be human component goes, I mean, that's a nice thing to hear. It's a nice thing to say, to like quantify that in your business.
What does that mean?
Yeah, I think like how you use that is look at the things that there is not much data to represent and figure out how you can create competitive advantages in that space specifically. So like things that are just hard to collect information on are going to have a larger moat to entry for a longer period of time. If you're competing with like AI companies or AI people that think they're going to do all these integrations, the things that are human have a moat because they're going to be harder to collect data on. And so that gives you some time to breathe. Like, it's probably not a permanent moat, but build some assets and some leverage and build a company around that. And then you'll be better positioned to pivot when that moat degrades as well.
Mm-hmm. So since I'm the human mojo side of our company, I'll still be relevant, but because Trevor's the data guy, he's going to be obsolete. I'll just be able to use a robot to do what Trevor does.
It's an interesting...
You're in trouble, Trevor. You love this AI stuff, but it's coming for you. It's coming for you.
Superpowers.
No, because he's humanizing it. He's communicating with it like it is a human being, just a really intelligent, very quick human being. And so he's getting interactions and value like it's a brain, not like it's a software.
I think that you can be... There's two obvious types of, I think there's dozens, but I think there's two obvious types of people that you can be in this like changing dynamic and do really well, which is like a Gabe type person where your name and your personality is the value. That can't be replicated with AI. Even if I can replicate your voice, if I send Mike an email that says, hey, wire me $1 million, we're going to do this deal together, he's not going to send it to me. It doesn't matter that he thinks it's you. If it's not you, it doesn't matter. So you have your people that are very human in their day-to-day have a moat still. Alternatively, if you are, let's say you spent 20, there's somebody listening to this podcast 45 years old, they spent 20 years running a title company that's 99% digital aside from their network, right? Which the network is worth something, but the rest is digital. Their angle, in my view, would be just be the best at integrating AIs and automations to make sure that you have like a margin that can survive a changing economy. So you have two paths. You can kind of be like the best at the new tools, or you can be someone that's more human-centric and like network-based. And maybe there's like some people that can do a little bit of both. But I think those are like two obvious ways to survive the next 10 years. Mm-hmm. After that, we've never known what's going to happen 10 years from now, so don't look that far.
So Investor Lab, PDX in Salem happens the second Thursday
of every month,
but it alternates 1 month in Portland, next month in Salem. So
you can Google it. You can go on all the socials.
Facebook, Instagram, everywhere you want to go. So next month is April. So the second Thursday of April, you'll be
Salem
still at the Sassy Onion, or did you move it?
Forge.
Oh, you're at the Forge.
Yeah. So April 9th,
we're at in the Forge
in Cellar 54.
Downstairs.
Oh,
yeah. So that's fun.
They got a cool event space. They have a nice little bar. They've got a VIP green room. They've got a little ping pong table.
A green room. What do? Smoke weed in there?
Yeah, right before we go out on stage. And then the speakers are the developers of the Forge, AJ Nash, who we had on the podcast.
Oh, they're going to be there next month.
Yeah,
talking.
Chris Blackburn of Clutch Industries and Nat Borchers.
Oh man, that'll be a powerhouse. You don't want to miss that one.
So it'll be a panel. AJ is going to give the backstory. Chris Blackburn and Nat will do their visionary things, and then we'll have a panel. And AJ has some thoughts about putting Chris on the hot seat when it comes to housing and projects, and they do have some interesting ideas at schools.
So it's what, $10 to get in, free drink? That's the Salem one. It costs a little more up in Portland.
$20 in Portland.
$20 in Portland. Okay, but you get a drink with that.
Of course.
So Portland is more expensive. A drink is $20 in Portland, and it's only 10 in Salem.
I'm sorry.
So at your event last night, did the lender say we could buy deals again, or did he tell us not to buy deals again?
No, he said real estate is his favorite asset class.
Okay.
So he still feels good about
That's the
real
right
estate.
thing to say. But should we buy any? What did he say about that?
I mean, I was much more against real estate than him. I think if you listen to it, like he kept saying inflation and assets, and I kept having to counter him and say, except assets tied to interest rates, because inflation keeps the interest rates high, and right now that's keeping values low.
Yeah.
And so we talked about buying deals, being sustainable. Yeah.
All right.
Okay.
Well, let's talk about deals, because Trevor's falling asleep.
That was his line.
Yeah. Oh, yeah. Sorry, Trevor. I stole your thunder.
That's okay. All right, let's start with your favorite deal.
Okay. Well, then I'm going to start with like what was supposed to be my closer. So this is my favorite deal because I was able to use what I had learned in real estate to create like probably the most pivotal like lifestyle improvement. So I got to use real estate skills to improve my lifestyle and like just like my daily well-being. So it's not the best, maybe it's not the best like
that's the best deal.
But it's like the best deal if you want to ask, if you want a literal answer. So I just closed on this like 3-4 weeks ago. Basically what had happened is I had convinced my wife to buy a off-market like wholesale house a few years back, and just like a small 2-bed, 2-bath. We have a little equity there, but it's not the favorite deal. The point is, we always knew we were going to move. It was never meant to be like a permanent place to stay. And so we always felt like it was like, do you unpack this box or not? Like, I don't want to spend 10 grand on this thing because we're not going to use it for more than a couple of years. And so we always knew we were going to move. And then we had like a kind of a close call. Like, we're in a perfectly safe neighborhood, but we just happened to have a neighbor that, long story short, shot a bullet into our house and almost hit my wife. Missed her by like 2 feet. And so after that happened, we were like, we need to fast track this moving thing. Like it became a real conversation. And basically what it boiled down to is we agreed we needed to move. And I go, but okay, honey, I can't buy a shitty deal. So we're going to have to like intersect these two things somehow. And she's been fantastic. I mean, she's been an incredible supporter of what I do, especially considering she doesn't really have that much interest in real estate. And so she understood that I needed to buy a good deal and gave me a year to figure it out. And but she didn't really want to live in like a fourplex house hack type situation. She didn't want to do a fix and flip. We were okay flipping into equity, but she wanted to move in when it was done. And I was like, gosh, that doesn't leave me with like any great options. And so I just, out of pressure, I started looking for something new. And I figured it boiled down to 3 options: a seller carry, which is like great terms; sub 2, which I was like on the fence about, but it was on the table; and then an assumption. And assumption is like going to be the number 1 word in my vocabulary for the next 12 months because it's my current favorite strategy for people that are bankable and like looking for their first or like early deal. So a lot of people complain. I hear this all the time, that people complain about like, oh, half the real estate is owned outright. Like they don't even have debt on it. And then they're like, and then almost everybody else has 2-3% interest rate because they all refied during COVID. Exactly. All I hear is there's a bunch of seller carries out there, and there's a bunch of loans that are assumable and sub-2able. And so that became my objective. I became hyper-fixated on finding an assumption at like a 2-3% interest rate, and all I would have to do is like close the equity gap somehow. And theoretically, we could get any house as long as we were okay with the payment. And kind of my metric for what I was okay with is day one when we move in, if shit hit the fan and we had to move out, it would rent for a few $100s more than our mortgage. And so that's pretty easy to do at 2-3% interest rates. So for people looking for one of these, I did this all on market. There's a dozen off-market ways you can do this, but brokers are marketing assumptions in their listings now. So if you're in like a major city like Portland or Salem, there's going to be enough that you have like some selection. There's not a ton, but there's enough that you can kind of like look at it daily, and there'll be one every week or so. And so we did that for 8 months. We put in offers on a couple deals. Finally, this one comes on the market, and they're asking, it was like $580, $590. And they had marketed it as an assumable loan, 3% interest rate, VA. Okay. So we are not VA, but VA loans are assumable, and the entitled seller, they have their VA entitlement, they can gift that to the buyer. And
does that mean they can't use it again on their next deal? Or?
No.
So they could just keep buying deals and entitle these to whoever buys it?
It does affect them, but it doesn't prevent them from buying another deal. Effectively, like at a high level, their VA entitlement is capped at a certain debt amount per county. But most counties are like high, like almost $1 million in most counties. So if they sell you like a $500,000 house, they can probably go out and get another house. It almost is a moot point though, because if you're solving their problem, they might be fine with that anyway. Now, granted, it's a lot easier if you're VA, because then you don't have to convince somebody to do the gifting of the entitlement. So this deal was like a $590,000 house, 21 build, 3% interest rate, like 3 times the lifestyle enjoyment of our last place. It's just big. It's nice. My wife loves it. We never need to move. We can have kids in this house. It's safe, good neighborhood. And our mortgage is only $200 more than where we were living before.
Where you almost got shot.
Where we almost got shot. Which actually, it's funny because I am in a lot of shitty parts of town on a regular basis. And the first time we almost got shot was in like
your own primary
that we own.
In your own house.
So
that right there is why transaction volume is a historic low.
So the catch with this was between they had put money down, and also because they have a low interest rate at this point, like 4 years, 5 years out from COVID rates, because they have a 3% interest rate, they're paying down a lot of principal every month. So most cases, if you find one of these, they're going to have like 10 to 20% equity at least. Sometimes like you could get lucky and find less, but a lot of times you're gonna have 10 to 20% equity. You have to close that gap. So you can close it with cash, but in this case, that would have been a little over $100,000. I don't want to bring $100,000 to a deal. So we double closed. We found a lender that will close a HELOC on the deal, like not on a different deal. So on closing, I get the VA loan at 3%, and then I get everything up to 90% from the HELOC. And then we just bring the delta. That deal, like on paper, the only equity that we have is our cash. So from a net worth perspective, there's not much there, but the debt is incredible. And my favorite part about this is I'm buying the deal on the value of the debt. But if rates, like houses sell based on affordability, people don't really care about like the raw number. More or less, they're just backing in what can I afford to buy? That's how the bank's underwriting them. So somebody would have bought this house at like whatever, $570, and their payment would have been like $4,000, $4,500 a month. So if rates go down to 3% or close to it, where you could buy down to 3%, the value of my debt is zero. But now a $4,500 payment on this house would support like a $750,000 purchase price. So if my debt goes to zero, my equity goes to like 150. And it's just like this one-sided trade. And all the while, if I ever can't live there or don't want to live there anymore, I can rent it for like $500 more than I paid. I've been talking about this deal a lot lately because the window on this is closing. The more equity these people have, the harder it will be to do this type of deal unless rates go back down to 3 or whatever and you get like a reset on this opportunity. But in 10 years, people will have like 40, 50% equity. And if you close the gap with a HELOC or even cash, it's probably not efficient anymore after you like weighted average your interest rate.
Wow. So you talked about sub 2 a little bit. Why do you like assumption better than sub 2?
this sub 2 has more scale to it, I guess, because I can do as many sub 2s as I can convince people to sell me. The assumption, like our name is on that debt, it's owner occupied. We can only do one a year each or one a year total if we're both on the debt. So they both have their advantages. Part of the reason why like sub 2 isn't my focus is as far as like real estate acquisition goes, I typically just focus on deep basis. And so for me, it's easier to just focus on deep basis than like 6 different buy strategies and miss opportunities as a result. And then like, I don't know, I don't love the conversation with the seller where it's like, yeah, the debt's still in your name. And like, we're going to have to text every month for the next 17 years because you're going through this, that, and the other. I think there's value to this strategy. It's just not my personal focus.
It's cleaner.
Yeah, I like clean. I like a clean, like I like on closing day, we win our separate ways. You got your money and I got mine.
So VA, they can gift their entitlement. That's one assumption, but you're saying that not all loans are assumable. So you're kind of a needle in the haystack, but brokers are starting to bring possible assumptions to the table and they're marketing them that way. So you can find them.
Yeah, so VAs are assumable, FHAs are assumable, and then some conventional are assumable. If you're not happy with the supply that's listed on the market, you can just go to like PropStream or Pelago or something, and you can just set filters for people that have low equity and low interest rates, and just call them all if you want. I didn't even bother. I know how to do that. I didn't even bother.
If that seller didn't need the cash, is there a scenario where they could have carried the down payment in the form of a note and been in second position and the lender would have allowed that, or would they only let you go up to 90% either way?
Probably going to depend on the lender. The 90% for us was based on the second position lender's criteria. First position assumption never cared. So the first position is going to make that determination, I guess.
And they're already giving 100% loan with VA. So
yeah, and if you're working, like if this is your first deal, you might have a few less levers to pull. But if you have equity somewhere else and they're open to that, my angle would be just collateralize against a different asset on the back end, and then it's like net the same cash for you.
Okay, I like it.
So that deal was like a lifestyle creep meets financially feasible. I mean, we couldn't have afforded that house had we not done that structure. And so
lifestyle creep or life threatening.
We made amends with the shooter, so we could have stayed and like probably.
You're like, hey, no worries, you shot a bullet.
He was accidentally trying to kill your wife.
Yeah, it was like, I think like he couldn't have seen her where it happened, so it was like pure coincidence, and he had like a mental break. So long story, we ended up living with her family for a few months, but long story short, we like made amends. He's apologized, and then he moved to Texas. So we could have stayed and like been fine. But at that point, I realized how powerful the opportunity was, and I was like never going back. I was going to close one of these before the window, closes.
So did you keep that other house and rent it out?
Yeah, we have that's on the market now.
Okay. All right. So we want to know what keeps you up at night. You talked a little bit about your flip and how you learned a lot of lessons. Can you tell us about what's the deal that made you cry? What's the deal that made you and your wife fight? What's the one that made you lose sleep?
I think I've been fortunate in like the hard lessons I've learned. I've done my absolute best to insulate that pain from my wife. I think if it starts to like dramatically affect her, I've gone too far. And that's kind of like my barometer for like the risk I'm taking. Now, I have put us in tight spots and she didn't always know it. I think to demonstrate how much risk I've taken, I got married in July of 25, very recently. And you have to pay deposits like all the way through the process. But a lot of the money really starts to hit 30 days from the wedding. At that time, I was doing a couple deals. I had like all my cash out in these deals with no obvious path to getting it back. Like it was, if I got lucky, I'd get it back quick, but it wasn't like, oh, it will be back in 2 weeks. It was like, we'll see when I get it back. And so a month out from our wedding, we're paying all these deposits, running the account down to zero. Like a week before our wedding, I couldn't afford the honeymoon in cash. I could have put it on credit cards. Like I wasn't that far gone, but I couldn't afford the honeymoon in cash. So, and then the deal that brought money back into my pocket closed a week before the wedding. And so we go on our honeymoon and I spend a bunch of money in cash, and like I wipe the sweat from my forehead and then take that as like a data point in how I make decisions going forward.
I thought your wife's parents are supposed to pay for all that stuff. I thought you were a mooch. What happened? You didn't go ask them to pay for everything? You're just paying for it out of your pocket?
They contributed.
Oh, okay.
They contributed like more than we deserve. So
I'm teasing you. So, okay, so you got yourself close, but like you didn't tell us exactly like what got you so close. Like what was it?
Well, it's just spending all the cash on many deals, which you should do.
You got overinvested, which we all do. So what keeps you up at night?
Now, especially having been recently married, like having a house that I love and like feeling a lot of responsibility for the employees that I manage, I have something to lose now. For basically until the last year, a reset was never a problem. Like I really didn't have that much fear of bankruptcy or just like mental collapse and like start over. But now I feel like I have something to lose. And so I've never been in that position before. Even as a kid, we never had anything to lose. I've never had enough to lose that it was meaningful. And so now it doesn't change. I'm still being aggressive in real estate, but it changes like my liquid cash goals. It changes how aggressive I'm being in my underwriting. It puts a lot more focus on creating margin in my operation so that like shit can hit the fan and we have the spread for that. And that's been my goal like the last 6 months, and then it's or like 4 months. And then that's my focus for 26 is getting a little more cash heavy, de-risking deals, getting into long-term fixed rate debt where we're not, and then reevaluate once we're in that position.
This is the back off the gas pedal a little bit. Like just it's being more cautious.
I think it's flooring it where things work and I feel confident, and getting out of the car where it doesn't work.
You had a really good benefit when you tell your story about you really went all in when you didn't have a lot to lose. And a lot of people that are getting in already have a lot to lose, or they have a spouse that's not supportive. I think that there's something to be said for having somebody that's got your back. They know maybe you'll lose it all, but so what? They're out there. I've always said that your spouse is your most important partnership. So I think it's really important, especially if you're not married yet, to be thinking about who you partner with, because even, my wife, up until recently, she had no idea what I was doing. And then one day she started to realize, like, holy crap, like, what is Gabe up to these days? She just knew that she trusted me and she thought I was smart and I was making the right decisions. But there was a moment in time where, I was about ready to have a heart attack from the things I was doing. And I don't think she cared about the money. She just didn't want me to die in the middle of the night freaking out over deals. So like there's Mike, the first time I ever met Mike, Trevor and Dane were sitting there and Mike goes, well, how much is too much? And I'm like, if it's keeping me up at night, I went too far. And he's like, that's a great barometer. Like to me, 8 hours of sleep at night and I'm not waking up in a pool of sweat thinking I'm going to have a heart attack. I've pushed it too far. And there are moments in time where no matter what you do, you're going to get stressed out because there's always problems to solve. But the problems, if they're pushing you to the point where you're losing your health or your relationships or, suffering from the decisions you're making, I agree with you. Like you don't want to lose your wife over this. You don't want to lose your life over this. Like we're having fun. We're making money. We're doing a good thing. It's not always easy. Every day there's going to be a new fire to put out. But if you're waking up at 2 a.m, you could fry an egg on your chest, you've pushed it too far.
Yeah, I think for those that have something to lose, and I'm not the most experienced person to speak on this topic, but I would say if I were starting over and I had already built something, like I had a wife and kids and, like a nice house, and I was now trying to get into real estate, I would still be aggressive with my momentum, but more precise in where I choose to execute. So the reason why I was comfortable being so aggressive is, one, I had nothing to lose, but it didn't, like, there was no downside risk with that being the case. If I had something to lose, I would still be learning as fast as possible, getting involved in as many like networks as I possibly could, but I might just not do like a thinner margin deal. I might wait for a more promising partnership and not just the first person that's willing to marry me on a legal document. So I think you can still be really aggressive. I think it's no reason to not get in the game. If anything, you're protecting your future self from downside risk. But I think in the short term, just be more precise in what you decide to get into. Just don't like double leverage with double-digit interest rate on a deal that only works if the economy doesn't.
So don't.
at all.
You're saying don't be a cowboy. Don't go do something stupid just to do a deal.
Calculate the downside.
The only reason I'm so aggressive or have been is because all my goals stop at 30, and like I've had to be this aggressive in order to hit the right trajectory.
What's that goal?
A $10 million net worth by 30.
I thought it was too low because I feel like he's just going to hit it based on where he's at now.
It wasn't always too low.
He's always
Try to hit it early and then raise it.
minimizing
Double
people's
down.
goals.
I think a $10 million net worth by 30 is a very, very good goal.
I just think if he keeps doing what he's doing now, it's inevitable.
Yeah, but who knows? I mean, I think
I've met Cannon and hung out with him. It's just like, yeah, when he told me that, I was like, oh yeah,
So
like I feel like you'll do that right now.
So does the goal matter?
Not really, but I think Cannon said something in the last episode where he was talking about growth mindset versus protection and preservation mindset. And I think it's really important. I see this all the time where I've actually seen people who should have been in preservation mode, AKA Paul Curley, and he was in growth mode all the way till the day he left this earth, right? And then I've seen other people who are either too young to be in preservation mode, or they're older and they haven't built enough yet to be in preservation mode, which really puts you in a bad spot. Because when you're 65 and you're like, oops, I need to build a retirement,
you don't have time,
and I want to go, and it's like, now what do you do? Because now you should be sort of in preservation mode, but you have to be in growth mode, and you're putting a lot at risk when maybe you're at a stage in life where you don't want to put a lot at risk. So to be young is a major advantage to be in that growth mode.
People view risk in buying real estate, but I view it as more risky to not own assets.
Yeah,
what are you going to do?
Sure, but people don't think that way. You just explained the midlife crisis. That's exactly what it is, which is, shit, I'm running out of time. I don't have enough. I'm now afraid because I don't even know what enough is. And now my reaction to that is numbness with some type of fun or some type of splurge.
But you think about both of those mindsets between preservation and growth. You could be preservation all the way till you realize oh, I don't actually want to work anymore, or I can't work anymore, and I have no other way to replace my income. Or you could be growth all the way until it kills me because I never stopped and I never set things in motion to where at least if I wanted to slow down, I could, right? And so I think it's really important. And I'm only 50 years old, and I've only been doing real estate for a little over 10 years as an investor. But I've built something. I met with an estate person yesterday, and it's I've built something big enough now to where I got to get serious about what happens with it and what are the goals around that. And it's well, why am I buying the real estate? What am I doing? Well, number one, I'm a deal junkie, so I just like to buy deals. There is a dollar amount in there somewhere that I want to make money, obviously, because I want to win. If you're playing a game, you want to win some of the games, right? You don't want to always lose. But at the same time, it's I'm 50. And I'm not building a legacy for future generations, although I am. That's not my motive, is to build that for future generations. I want to live a good quality life. I want to have the money to do the things I want to do. I want to keep having fun. The problem is you build something, you get your $10 million net worth at 30. Well, what happens? None of us are promised tomorrow. What happens if you die at 30? Do you leave your wife $10 million and she can go off and live a great life and, do what she needs to do to move on? Or do you leave her a big, giant problem to solve? Well,
that's why the goal is a net worth number and has nothing to do with real estate. Because I love real estate. I'm a deal junkie, but at the end of the day, the goal is agnostic to real estate. So when I hit 30, I think about this a lot, planning for my wife. I want to have a $10 million net worth that will take care of my family if I'm gone. And that doesn't necessarily mean a bunch of doors paid off or with debt or with an operational company on top of it. What I want is a clean $10 million that can support my family if I'm gone and support me if I'm here. I've thought a lot about that number because it used to be lower and it creeps up as you think you're capable of more. The reason why I'm not moving it ever, well, at least until I'm 30, is if I think that the goal is going to be like easy to obtain, thank you for the vote of confidence, Trevor, then I will turn up the preservation dial and still hit the goal, right? So if at any point 10 million is going to be easy, I can start preserving earlier and take risk off the table. If I think I'm going to miss the mark, I can turn risk up and go back to that as like my core guiding light. So I don't move the number because like I think I can hit it, but can I hit it and have, like my new metric becomes, can I hit it and have a very safe, risk off, like cash flow heavy, pleasant portfolio that I'm excited to own at the same time? That's not the same thing. I mean, I could have a $10 million nightmare portfolio or a $10 million like pristine portfolio. And so if I think 10 million's easy, I start taking risk off and preservation on.
What does a risk off portfolio mean to you? What's that? Is like you're talking about cash flow heavy? Are you low leverage? Is you 50% levered? Like what is safe? Certain amount of cash, percentage of cash?
I like long-term fixed rate debt, and if I can layer on, a fair amount of equity so that there's a little more cash flow spread there, then I like that. I don't have a specific target because very few of my deals am I transitioning there right now. What's nice about doing deep basis is most of the time you preserve when you buy if you do deep basis. Like the equity is already there, and my path is always to long-term fixed rate debt. So when I buy, the only thing I have to do is refinance into long-term fixed rate debt, and then I'm done. I've already preserved, and there's probably some net worth there, and I can move on to the next one. If I just got handed $10 million tomorrow, I'd probably be out buying in cash extremely low basis deals, and then put like 50% leverage on them and go do that repetitively.
Have you lost money on a deal before?
$500.
I lost a lot of time.
I made $500.
I've never lost cash more than like maybe $1,000. But like I haven't gone full cycle on very many deals. I started buying in 22 when rates were going through the roof. I've never gone full cycle for the most part. I mean, like some refis and stuff, but I didn't get this like COVID pop that then like accelerated my whole portfolio and I could do all this stuff with. I grew in like when I started going to meetups, everybody was like, I don't know, the market's kind of tough right now. That's the only environment I've ever bought deals in. So I haven't lost much, but I haven't had very many
hits.
Yeah, very many
takes time.
Big hits. Yeah.
We'll have a follow-up episode.
Yeah. Cannon in 2 years comes in with long hair, half mullet, half skinhead, some mixture of barefoot and booted.
Oh, all right, man. It's been fun talking about deals with you, Cannon. Cannon St. Peter, he is the Director of Operations at Peak Asset Management. If you want to find him, he's on Instagram, Facebook. You can DM him, do all the things young people do these days. Ask Claude or ChatGPT how to find him. And
Can we do one more deal? I feel like we didn't do enough deals.
Trevor, we got to do a Facebook Live here.
Okay.
Do you have a deal you want to talk about?
No, I want to talk more cannons. That's okay. You can close it out.
Do you have a specific one you want to talk about?
I mean, they've done a bunch of deals, so I want to give like some details on one of them. Like you've done some 50 units, 12 units, like all those things.
How about I'll give you the 2-minute on the 50 unit. That way,
there we go.
People know I don't just do 1 to 4 units. So the 50 unit that I'm a small ownership partner, a GP owner in, came to us pre-market, but basically like anybody could have seen it if you're networking with brokers. Wasn't like that off market, just pre-market. Locked it up at like $6 million, and then this is back to the due diligence conversation. I saw all of those units. I hung out with their management for like 2 weeks. I talked to tenants. I figured out like where all the operational problems were before we had even released earnest money. And through that process, I had found several concerning due diligence items, again, where the perception of the problem is a lot greater, in that case, a lot greater than what I thought I could solve it for. But still like a reasonable argument. It's not like we're being unreasonable.
Was it operational or physical stuff?
Both on that one. I would say operational was like the more challenging thing from the average person, which is why so much of the discount came. But honestly, that turned out to be like probably the easier part because it's just we're so used to this.
Easy
it's not
for
weird
you,
to
hard
me.
for the seller. If it was easy for the seller, they would have already done it.
Yeah. So that deal went from $6 million to closed at 4.5, and then did an operational and physical lift. And
how'd you guys get the
smooth.
debt and equity for it?
It's bridge debt, and then syndicated equity, and I don't play a huge role on that side. I don't need to.
And
I think I could, but I don't need to.
So you do 4.5. What do you spend on it?
I think the budget, we had like a budget of over $1 million, but we didn't spend that.
Okay.
We didn't have to turn all the units to hit our numbers because the basis was so low. Back to basis. The basis was so low, we probably didn't have to turn any unit, and we could have refied after a couple years of seasoning.
And then have you done the refi yet on that one?
This year. We'll do it. Yeah.
What are you expecting that loan amount to come in at value?
I think the value, we just looked at this, is going to be like roughly 8.5. And then I think it looks like we'll probably get all of our investors' capital back and then like a little GP promote.
Yeah.
And then
Will you guys sell that deal, or you'll just refinance, pull cash out, and buy your investors out, or how will that work? Return the capital, leave them in the deal?
Yeah, return capital, leave them in.
Okay.
Yeah, I've been in just a couple syndications, and that's how we've been doing it.
All right. It's a good way to do it. Your investors will be happy. They get all their money back, and they still own the deal.
That's my favorite way to do a deal.
It's an easy sell, and not always, but like I think sometimes that's a better pitch to get more equity as the GP. Like we're never going to kick you out of this deal, but I need more upfront to get the job done. And like people seem to.
So you mean like more of a
more ownership
60-40 than a 70-30?
On that particular one, it might be like a 70-30. I can't remember. But we did one where it was 55 us, 45 them, and they loved it. They still get a great return, and they're staying in the deal long term. They had no problem with that. But like conventionally, that's a lot.
Cash out.
Yeah.
Yeah. It's not always very clear that you're going to get your cash out.
Yeah. With
Even
deep
with
basis,
deep basis.
It's not, you're right. It's not always clear, but sometimes.
Sometimes you know.
Yeah. When you're hitting like a 1.25% rule and expense ratio is relatively low because you're buying older property in Portland that benefits from like the Oregon tax rate hikes and stuff, you feel very confident. Like honestly, I don't really like taking investor money because I would never feel comfortable taking a loss and not paying them back. Like I'd have to pay them out of my own pocket, and that's more expensive money than anything. So if I could do every deal in my own cash or with partners that we were on the same page, like we're 50-50, we can both lose our money and I don't have to pay them back. That's my preference. But sometimes a deal is just like so good that the fear of having to pay people back is gone because I feel so good about them.
Yeah, that's how it should be. All right.
That's all I needed. That's all I needed.
I feel better.
We had to juice Trevor there for a minute.
I love it when we make Trevor smile.
All right. Cannon St. Peter, thanks for being on the show. Deal Junkies, we love you. Please share us with someone you love, and we'll see you next time.